The balance of global power is being tested in a domain that rarely makes headlines, but determines the outcome of nearly every strategic confrontation: money. As China accelerates efforts to reshape monetary relationships across trade, finance, and reserves, long-standing assumptions about U.S. financial primacy are under quiet pressure. This is not about abrupt displacement or symbolic gestures. It is about incremental shifts in settlement practices, currency usage, and institutional alignment that accumulate over time. These changes matter now because they coincide with rising geopolitical fragmentation, expanding fiscal demands, and growing skepticism toward universal financial rules. When monetary alliances evolve, leverage changes. Influence becomes harder to project, coordination more difficult to enforce, and shocks more costly to contain. The issue is not whether the system breaks, but whether it continues to function on terms the United States can still shape. China's recalibration of its engagement with dollar-centered financial channels is unfolding as a methodical, operational shift rather than an ideological rupture. The defining characteristic of this transition is its incrementalism. Chinese authorities and market participants are not positioning their actions as an attempt to overturn the existing global financial order. Instead, they are embedding alternative settlement practices into the daily mechanics of trade and finance in ways that reduce exposure to a single dominant currency without forcing counterparties into overt political choices. This distinction matters. By framing diversification as a risk management exercise rather than a geopolitical statement, China lowers resistance, attracts pragmatic participation, and avoids triggering defensive responses that might arise from more confrontational signaling. The result is a quiet reconfiguration of financial behavior that accumulates strategic significance precisely because it is not dramatic. At the core of this approach is the expansion of local currency trade settlement. For decades, the default invoicing and settlement currency for cross-border trade, particularly in commodities and manufactured goods, has been the US dollar. This convention offered efficiency, liquidity, and price transparency, but it also concentrated risk. For Chinese firms engaged in large-scale import and export activity, dollar dependence meant exposure to exchange rate volatility, funding costs tied to U.S. monetary policy, and vulnerability to financial restrictions imposed beyond their control. By increasing the share of trade settled in renminbi or in partner currencies, China reduces the frequency with which transactions must pass through dollar funding markets. Each individual contract may be limited in scope, but taken collectively, these arrangements alter transaction flows, balance sheet structures, and liquidity needs across the system. This shift is reinforced through the deliberate promotion of bilateral currency swap lines. These agreements between central banks are not new, but their strategic deployment has evolved. For China, swap lines serve multiple functions simultaneously. They provide liquidity backstops for partner countries engaging in renminbi settlement, reduce the need for dollar reserves in bilateral trade, and signal institutional support for non-dollar channels without mandating their use. Importantly, swap lines are framed as cooperative financial tools rather than political instruments. This framing allows counterparties to justify participation on prudential grounds, particularly in regions where dollar liquidity can be volatile or expensive. Over time, the existence of these backstops lowers the perceived risk of transacting outside the dollar, encouraging firms and banks to experiment with alternative settlement options that might previously have seemed impractical. Parallel to these policy-level initiatives is a less visible but equally consequential adaptation within financial institutions themselves. Chinese banks, along with regional and international partners, are investing in systems capable of handling multi-currency operations with greater efficiency. This includes upgrades to clearing and settlement infrastructure, expansion of foreign exchange risk management capabilities, and the development of internal expertise in regulatory compliance across multiple jurisdictions. These investments are driven by client demand rather than directive. Corporations engaged in cross-border activity increasingly seek flexibility in how they invoice, settle, and hedge transactions. Banks that cannot accommodate this demand risk losing business. As a result, commercial incentives align with strategic objectives, accelerating the normalization of diversified settlement practices without requiring explicit coordination. The cumulative effect of these changes is best understood through the concept of operational familiarity, financial B. Behavior is shaped not only by formal rules but by habit, expertise, and perceived friction. When firms and banks regularly transact in non-dollar currencies, they build internal processes, pricing models, and risk frameworks that make such transactions routine rather than exceptional. Liquidity pools deepen incrementally as volumes grow. Bid-ask spreads narrow. Hedging instruments become more standardized. Each of these developments reduces switching costs, making it easier to choose alternative settlement options in the future. This is a critical dynamic. The resilience of the dollar system has historically been reinforced by high switching costs, which discouraged experimentation even when theoretical alternatives existed. By systematically lowering these costs, China alters the calculus without requiring a decisive break. From a systemic perspective, this diversification does not eliminate the dollar's central role, but it does change its character. The dollar remains the dominant reserve currency, the primary unit of account for many commodities, and the anchor of global funding markets. However, its role becomes less exclusive. Transactions that once defaulted to dollar settlement increasingly present viable alternatives, particularly in trade corridors where China is the primary economic partner. This conditionality matters for U.S. financial influence. The power embedded in dollar-centric rails has always been most effective when access to them was indispensable. As indispensability erodes at the margin, leverage becomes more situational. Influence must be exercised through coordination and credibility rather than assumed through structural dominance. The implications for the United States are therefore subtle but significant. There is no sudden loss of control, no abrupt displacement of U.S. assets from global portfolios, and no immediate crisis of confidence. Instead, the risk lies in erosion of exclusivity over time. As more transactions bypass dollar-centric channels, the informational advantages, regulatory reach, and enforcement capacity associated with those channels become less comprehensive. Sanctions, compliance regimes, and financial monitoring tools remain powerful, but their coverage becomes less universal. In regions where China is a primary trading partner, local actors may increasingly perceive diversified settlement as the prudent baseline rather than a political statement. This perception reduces the reputational and operational cost of choosing non-dollar options, further reinforcing the trend. It is also important to recognize that this evolution is occurring within a broader context of heightened geopolitical risk. Sanctions regimes, export controls, and financial restrictions have become more prominent tools of statecraft. While effective in specific cases, their expanded use has underscored the vulnerability of concentrated financial dependencies. China's adaptation should be understood against this backdrop. By embedding alternatives into normal commercial activity, China reduces the need for abrupt adjustments in the event of stress. The system becomes more modular, allowing specific channels to absorb shocks without forcing wholesale disruption. This resilience is not absolute, but it represents a meaningful improvement over reliance on a single set of rails subject to external policy decisions. The strategic sophistication of this approach lies in its patience. Rather than seeking immediate transformation, China is shaping incentives and infrastructure that guide behavior over time. Each additional local currency trade agreement, each new swap line activation, and each bank capable of seamless multi-currency settlement contributes incrementally to a more plural financial environment. These changes rarely command attention individually, but their aggregate impact compounds. Markets and policymakers accustomed to assessing risk through discrete events may underestimate the significance of this accumulation until it is well advanced. For global financial stability, the implications are mixed. Diversification can reduce systemic risk by spreading exposure and reducing single points of failure. At the same time, it introduces complexity and reduces the efficiency benefits of uniformity. Pricing becomes more fragmented, liquidity more distributed, and coordination more challenging in moments of stress. These trade-offs are increasingly accepted by participants who prioritize resilience over maximal efficiency. China's strategy aligns with this preference, offering partners a way to balance access to existing systems with the option to route around them when conditions warrant. In assessing the trajectory of this shift, it is essential to avoid binary thinking. The question is not whether the dollar will be replaced, but how its role evolves as alternatives become more functional. China's actions suggest an environment in which the dollar remains central but no longer singular. Its distinction has profound implications for power projection, crisis management, and long-term trust in financial architecture. A system with multiple viable settlement pathways demands greater policy discipline from its leading actors, because confidence becomes contingent rather than assumed. As this process unfolds, the United States faces a strategic choice. It can interpret diversification as a threat and respond defensively, or it can recognize it as a signal that influence must be maintained through stability, predictability, and engagement rather than reliance on structural choke points alone. The erosion of exclusivity does not equate to irrelevance, but it does require adaptation. China's embedding of alternative settlement practices is not an endpoint. It is a pathway that reshapes incentives across the system. The longer it persists, the more those incentives become self-reinforcing, making reversal increasingly unlikely. In the present moment, the most consequential aspect of this shift is its normality. Transactions continue, markets function, and growth proceeds. There is no visible rupture. Yet beneath this surface continuity, the architecture of global finance is becoming more plural, more conditional, and more sensitive to policy credibility. China's reduction of reliance on dollar-centered channels exemplifies this transformation. It is a process measured not in announcements but in workflows, contracts, and balance sheets. For those assessing global power through financial structures, this is where the recalibration is most advanced, and where its long-term effects will be most enduring. The formation of monetary alliances in the current global environment is proceeding through mechanisms that differ fundamentally from the alliance structures of the past. There are no founding charters, no signature ceremonies, and no explicit declarations of alignment. Instead, cooperation is emerging through the gradual accumulation of institutional linkages, regulatory accommodations, and incentive structures that align interests without requiring formal commitment. This method is neither accidental nor opaque. It reflects an adaptation to a world in which overt blocks carry political cost, while functional coordination can be advanced quietly through the architecture of finance itself. The result is a dense web of monetary relationships that operate beneath the surface of traditional diplomacy, reshaping leverage and influence in ways that are difficult to measure in real time but consequential over the long term. At the center of this shift is the recognition that modern financial power is exercised less through proclamations than through access, standards, and interoperability. Monetary cooperation today is embedded in payment systems, clearing arrangements, development finance, and regulatory compatibility. China's engagement with these domains illustrates how influence can be extended without challenging existing institutions directly. By participating in, and in some cases sponsoring, regional payment platforms, alternative settlement systems, and multilateral development banks, China creates parallel pathways that coexist with established frameworks such as the dollar-based correspondent banking system and Bretton Woods institutions. These pathways do not require participants to withdraw from legacy systems. Instead, they offer additional options, allowing states and firms to diversify exposure while maintaining continuity. This dual-track behavior is a defining feature of the current moment. Participants in emerging monetary cooperation are not making binary choices between alignment and opposition. They are hedging. A central bank can hold dollar reserves, participate in IMF programs, and still engage in bilateral swap arrangements or regional clearing systems that reduce reliance on a single channel. A commercial bank can maintain correspondent relationships with U.S. institutions while investing in infrastructure that supports alternative settlement currencies. This layered approach reflects a rational response to uncertainty. It allows actors to preserve access to global liquidity while reducing vulnerability to policy decisions taken elsewhere. Over time, however, this hedging behavior alters the balance of influence embedded in the system. Institutions play a critical role in normalizing this form of cooperation. Development banks, regional financial arrangements, and cross-border investment platforms create recurring interactions that align incentives without requiring ideological alignment. Financing projects through non-traditional channels familiarizes borrowers and lenders with alternative standards, currencies, and governance practices. Regulatory cooperation agreements reduce friction in cross-border operations, making it easier for financial institutions to operate across multiple systems simultaneously. Each of these interactions reinforces the viability of a plural monetary environment. None of them individually displace existing structures. Collectively, they reduce the centrality of any single framework as the exclusive venue for global finance. The strategic sophistication of this approach lies in its resilience. Formal blocks are visible and therefore vulnerable. They can be targeted through diplomatic pressure, sanctions, or counter-alliances. Informal networks embedded in commercial and institutional practices are harder to unwind. Once payment systems are interconnected, once regulatory standards are harmonized across regions, and once firms have invested in the capacity to operate within multiple frameworks, reversing those choices carries economic cost. This creates path dependence. Even if political conditions shift, the infrastructure and incentives that support diversified monetary cooperation remain in place, continuing to shape behavior. For the United States, this evolution complicates the exercise of financial leverage. Historically, the effectiveness of U.S. influence has rested on the centrality of dollar-based systems and institutions. Compliance and alignment were often binary. Access to global finance required adherence to rules enforced through a relatively unified architecture. As monetary cooperation becomes more distributed, compliance becomes a matter of degree. An actor may be partially integrated into dollar systems while also maintaining viable alternatives. This reduces the immediacy and predictability of leverage. Tools remain available, but their effects are mediated through a more complex network of relationships. This complexity becomes particularly consequential in moments of stress. Financial crises, geopolitical shocks, and sanctions episodes test the capacity for coordination. In a fragmented environment, aligning responses across overlapping systems is inherently more difficult. Liquidity provision, regulatory forbearance, and crisis communication must navigate multiple channels, each with its own governance structures and priorities. No single actor can assume that its preferred framework will serve as the default venue for response. Influence must be negotiated rather than imposed, and the speed of coordination may be slower. These frictions do not guarantee instability, but they reduce the margin for error. It is important to emphasize that this redistribution of power does not imply the eclipse of the United States or the dollar. Systemic importance persists. Dollar markets remain the deepest and most liquid. U.S. institutions continue to set critical standards in finance and regulation. However, systemic importance is no longer synonymous with unilateral control. The presence of overlapping mechanisms means that influence is exercised in a more competitive environment. States and institutions can compare terms, choose among options, and shift behavior incrementally in response to perceived risk. This optionality alters negotiating dynamics across trade, finance, and diplomacy. China's role in fostering this environment is notable not because it has created an alternative order, but because it has facilitated the conditions for coexistence. By engaging with regional initiatives and multilateral platforms that emphasize functionality over ideology, China positions itself as a partner in risk mitigation rather than a challenger to global norms. This positioning lowers the political cost for participants. Engagement can be justified on commercial or prudential grounds, even when it has strategic implications. Over time, this blurs the line between economic cooperation and geopolitical alignment, making influence harder to attribute and counter. The implications extend beyond state actors. Multinational corporations, financial intermediaries, and institutional investors are active participants in this process. Their decisions about where to clear transactions, how to hedge currency exposure, and which regulatory regimes to prioritize contribute to the shape of the system. As these actors build capabilities across multiple frameworks, they reinforce the viability of plural arrangements. Their primary motivation is risk management, not geopolitics, but the aggregate effect of their choices is geopolitical. Power accrues to those who can shape the environment in which these choices are made. From a strategic intelligence perspective, the most significant risk lies in underestimating the cumulative effect of these developments. Because they lack dramatic milestones, they are easy to dismiss as technical adjustments. Yet history suggests that shifts in financial architecture often occur through precisely this kind of gradual institutional evolution. The gold standard did not collapse overnight. Bretton Woods did not emerge fully formed in a single moment. In each case, the alignment of incentives, institutions, and practices preceded formal recognition of change. The current evolution toward distributed monetary cooperation follows a similar pattern. As this process continues, the capacity of any single actor to set terms unilaterally diminishes, even if that actor remains central. Influence becomes relational rather than absolute. It depends on credibility, consistency, and the ability to coordinate across systems rather than command a single one. For the United States, this underscores the importance of maintaining the attractiveness of its institutions and markets, not merely their scale. For China and other participants, it highlights the value of embedding cooperation in structures that are durable and adaptable. The broader implication is a global financial system characterized by overlap rather than hierarchy. Such a system can be more resilient, but it is also more complex and less forgiving. Missteps propagate through multiple channels. Policy signals are interpreted across diverse frameworks, amplifying uncertainty if credibility is questioned. In this environment, trust becomes a critical asset. It is not conferred by dominance alone, but earned through predictable behavior and respect for the rules of engagement across systems. The emergence of monetary alliances through institutions and incentives rather than formal blocks therefore represents a structural shift in how power is organized and exercised. It does not announce itself. It advances through spreadsheets, compliance manuals, and payment codes. Yet its consequences are strategic. By distributing influence across overlapping mechanisms, it constrains unilateral action and elevates the importance of cooperation, even among competitors. This is the context in which current monetary dynamics must be understood. The system still functions, but on terms that are more negotiated, more conditional, and more sensitive to credibility than before. U.S. financial power has never been a function of command in the traditional sense. It has not relied on formal ownership of global markets or explicit control over foreign capital flows. Instead, it has been anchored in confidence. Confidence that U.S. markets are deep enough to absorb shocks, liquid enough to function under stress, and predictable enough to anchor long-term planning. This distinction matters more now than at any point in the post-Cold War period, because confidence is a conditional asset. It is earned continuously, not enforced, and it can weaken gradually without a single triggering event. The current environment reveals a shift from a system where U.S. financial dominance was structurally assumed to one where it must be actively reaffirmed through policy coherence and institutional credibility. For decades, the United States benefited from a reinforcing cycle. Global trade and finance relied on dollar-denominated instruments, which generated consistent demand for U.S. assets. That demand supported deep capital markets, low funding costs, and a perception of stability that attracted even more capital. This self-reinforcing structure allowed the United States to exercise influence indirectly. Sanctions were effective because access to dollar clearing was indispensable. Regulatory standards propagated globally because participation in U.S. markets was non-negotiable. Monetary policy decisions in Washington transmitted rapidly through global funding conditions because there were few substitutes with comparable scale and reliability. That structure still exists, but it is no longer exclusive. The critical change is not the emergence of a rival that matches U.S. financial capacity in totality, but the steady improvement of alternatives at the margin. These alternatives do not need to replicate the full depth of U.S. markets to matter. They only need to be credible enough to introduce choice. When actors have choice, even limited choice, leverage changes. Decisions that were once automatic become conditional. Compliance becomes situational rather than assumed. Confidence in this context is increasingly sensitive to policy coherence. Markets assess not only individual decisions, but the alignment between monetary policy, fiscal trajectory, and political governance. Large fiscal deficits can be absorbed if they are perceived as temporary or growth-enhancing. Monetary accommodation can be tolerated if it is clearly bounded by credible exit strategies. Political polarization can be discounted if institutional processes remain predictable. When these elements drift out of alignment, confidence erodes incrementally. There is no sudden withdrawal, but risk premia adjust. Funding costs edge higher. Volatility becomes more persistent. These shifts are subtle, but they compound over time. Geopolitical risk now interacts with this confidence dynamic more directly than in previous cycles. The expanded use of financial sanctions has demonstrated the reach of U.S. power, but it has also clarified its mechanisms. States and institutions can observe precisely how access is restricted, which channels are vulnerable, and where dependencies lie. Transparency has encouraged defensive adaptation. The objective is not confrontation, but insulation. By developing alternative settlement routes, reserve compositions, and funding arrangements, actors reduce the tail risk associated with political escalation. Each adaptation marginally reduces the automaticity of U.S. leverage. Importantly, the effectiveness of sanctions and regulatory reach depends on the absence of viable substitutes. When there is no alternative, compliance is immediate and widespread. When alternatives exist, even if they are less efficient, the calculus changes. Actors weigh cost against exposure. Some accept higher transaction costs in exchange for reduced political risk. Others diversify incrementally, maintaining access while lowering concentration. Over time, these decisions reshape the environment in which U.S. tools operate. Enforcement remains possible, but outcomes are less uniform and less predictable. China's role in this process illustrates the shift from displacement to optionality. There is no requirement for China to supplant the dollar as the primary reserve currency to affect U.S. financial power. The threshold is lower. By enabling enough optionality for trade settlement, financing, and reserves, China alters incentives. States do not need to abandon dollar usage, they only need to reduce exclusive dependence. Once that dependence weakens, U.S. influence becomes more contingent on maintaining trust rather than exercising authority. This places renewed emphasis on U.S. domestic policy discipline. External leverage is no longer insulated from internal dynamics. Fiscal sustainability, regulatory consistency, and institutional integrity directly affect global perceptions of stability. Markets and governments assess whether policy choices are reversible, whether commitments will be honored across political cycles, and whether crisis responses will remain predictable. When confidence is high, the system absorbs strain. When confidence weakens, the same level of strain produces outsized effects. The distinction between control and confidence is especially relevant in crisis scenarios. Control implies the ability to compel behavior quickly. Confidence implies voluntary alignment based on perceived benefit and safety. In a confidence-based system, coordination requires reassurance. Liquidity provision must be credible. Policy signals must be coherent across agencies and branches of government. Mixed messages amplify uncertainty. Delays in decision-making erode trust. These dynamics increase the cost of crisis management, even if ultimate outcomes remain favorable. Another dimension of this constraint is temporal. Confidence erodes faster than it is rebuilt. A single episode of perceived disorder can have lasting effects on expectations, particularly among long-horizon actors such as reserve managers and sovereign wealth funds. These institutions prioritize stability over return. When they adjust portfolios, they do so gradually but persistently. Small reallocations, repeated over time, alter demand patterns for U.S. assets. This does not trigger a collapse, but it changes the baseline against which policy operates. The United States retains unmatched advantages: scale, legal infrastructure, transparency, and innovation. These advantages are real and durable. However, their effectiveness now depends on continuous reinforcement. Structural inevitability has given way to competitive credibility. Other systems do not need to outperform the U.S., they only need to be good enough to serve as fallback options. In that environment, complacency becomes a strategic risk. This shift also affects alliance management. Partners who once aligned automatically with U.S. financial preferences now weigh domestic considerations more carefully. Exposure to secondary sanctions, regulatory spillovers, and currency volatility factors into decision-making. Alignment becomes negotiated rather than assumed. This does not signal disloyalty, but pragmatism. States seek to maximize autonomy while preserving access. The result is a more fluid alignment landscape, where influence must be exercised through persuasion and reliability rather than structural dominance alone. From an intelligence perspective, the most significant danger lies in misinterpreting this environment as static. The absence of dramatic breaks can create a false sense of security. Yet financial power has always shifted through accumulation rather than rupture. Confidence-based systems appear stable until they are not, precisely because adjustments occur below the threshold of immediate visibility. By the time effects are obvious in headline indicators, the underlying dynamics are already entrenched. The constraint on U.S. financial power is therefore not a loss of capability, but a change in operating conditions. Influence must be maintained through consistency, restraint, and long-term discipline. Short-term gains achieved through aggressive use of financial tools may carry long-term costs if they accelerate the search for alternatives. The balance between enforcement and preservation has become more delicate. In this environment, the central strategic question is not whether the United States can still shape global finance, but how. Control-based assumptions lead to overreach and miscalculation. Confidence-based strategies require patience and coherence. They demand that domestic policy choices be evaluated not only for internal impact, but for their signaling effect globally. Stability itself becomes a form of power. The current moment underscores that U.S. financial influence is no longer self-executing. It must be actively sustained in a system where choice is expanding and loyalty is conditional. The dollar remains central, but centrality alone is insufficient. What matters increasingly is whether global actors believe that alignment with U.S. markets will remain advantageous across political cycles and geopolitical shocks. That belief is the foundation of confidence, and confidence is now the primary constraint and the primary asset of U.S. financial power. The current shift in monetary alignments is occurring against a backdrop of elevated global stress, and its most immediate consequence is a sharp increase in systemic complexity. This complexity is not inherently pathological. Financial systems have always evolved toward greater sophistication as trade volumes expand, capital flows deepen, and instruments diversify. However, the present transition differs in character because it coincides with weakening centralization at precisely the moment when coordination capacity is most needed. The global financial system is moving away from a structure anchored by a small number of universally trusted channels toward one defined by overlapping mechanisms, partial substitutes, and regionally embedded arrangements. This transformation alters how shocks propagate, how quickly responses can be organized, and how effectively authority can be exercised under pressure. Historically, the efficiency of crisis management rested on standardization. A limited number of settlement currencies, payment systems, and liquidity providers allowed stress to be identified rapidly and addressed through well-rehearsed pathways. Market participants understood where ultimate backstops resided and how policy signals would transmit. Central banks could coordinate because they operated within a shared framework of expectations and instruments. Legal regimes, while diverse, were anchored to common principles that facilitated emergency action. This architecture did not eliminate crises, but it constrained their escalation by providing clarity during periods of uncertainty. As monetary relationships diversify, that clarity is diluted. Multiple settlement currencies, parallel payment rails, and heterogeneous regulatory regimes introduce layers of interpretation into every transaction. Participants must assess not only market risk, but also jurisdictional exposure, legal enforceability, and political sensitivity. During normal conditions, these considerations can be managed through pricing, hedging, and contractual design. Under stress, they become sources of delay and confusion. When liquidity tightens, knowing which channels remain open, which backstops apply, and which obligations take precedence is no longer straightforward. Liquidity provision illustrates this challenge with particular force. In a centralized system, the extension of liquidity by a dominant central bank or a coordinated group of authorities can stabilize markets quickly. The credibility of the provider and the universality of the channel ensure rapid uptake. In a fragmented environment, liquidity provision must contend with segmented markets. Funds may not flow smoothly across borders or currencies due to regulatory constraints, capital controls, or counterparty concerns. Even when liquidity is ample in aggregate, it may not reach the points of greatest stress in time. The result is a system that appears liquid on paper but behaves illiquid in practice. Cross-border funding markets are similarly affected. These markets depend on trust in settlement finality, legal predictability, and the reliability of intermediaries. As funding structures become more diverse, the chain of trust lengthens. Each additional link introduces potential points of failure. During periods of heightened volatility, lenders reassess exposure not only to borrowers, but to the entire infrastructure through which transactions pass. This reassessment can trigger abrupt withdrawals, even in the absence of fundamental insolvency. Fragmentation amplifies precautionary behavior, reinforcing stress through self-protective actions. Coordination among authorities becomes more difficult in this context. When systems were more centralized, coordination benefited from shared assumptions and established hierarchies. Today, authorities operate across partially overlapping domains with differing priorities and constraints. Aligning responses requires negotiation rather than execution. Time is lost in consultation, and policy measures risk inconsistency. One authority's stabilization effort may inadvertently tighten conditions elsewhere. Another's regulatory intervention may redirect flows into less transparent channels. These interactions do not reflect incompetence, but the structural challenge of governing a system without clear focal points. Legal uncertainty compounds these difficulties. Fragmented settlement environments often rely on bespoke agreements, bilateral arrangements, and evolving standards. In calm periods, these structures function adequately. In crises, ambiguities surface. Questions arise regarding jurisdiction, enforceability, and the hierarchy of claims. Disputes that would once have been resolved through established norms now require interpretation. This uncertainty raises risk premiums and encourages preemptive retrenchment. Market participants prioritize capital preservation over intermediation, exacerbating stress precisely when intermediation is most needed. The timing of this shift is particularly concerning because it coincides with historically high global debt levels. Sovereign, corporate, and household balance sheets are more leveraged than in previous cycles. High leverage reduces tolerance for volatility. Small disruptions can have outsized effects on solvency perceptions and refinancing conditions. In such an environment, the ability to mobilize coordinated responses quickly is not a luxury, but a necessity. Fragmentation weakens that ability by introducing procedural and operational friction at every stage of intervention. Geopolitical risk further intensifies the challenge. Strategic competition, sanctions regimes, and political polarization have already increased uncertainty around cross-border finance. Monetary diversification is partly a response to these pressures, but it also feeds back into them. As financial channels become entangled with geopolitical considerations, trust erodes more rapidly under stress. Market participants cannot easily distinguish between technical disruption and political intent. This ambiguity encourages defensive behavior, reducing liquidity and amplifying volatility. The United States remains uniquely positioned within the system. Its financial capacity, institutional depth, and central role in global markets are unmatched. However, capacity alone does not guarantee effectiveness. Exercising influence now requires navigating a landscape where authority is dispersed and expectations are less uniform. The assumption that U.S. intervention will automatically anchor markets is no longer sufficient. Interventions must be calibrated to account for diverse transmission channels and varying sensitivities. Communication must be precise, because signals are interpreted across multiple frameworks with different historical experiences and risk perceptions. This does not imply a decline into disorder. Complex systems can be resilient if they are well understood and properly managed. The risk lies in misalignment between system design and policy assumptions. If authorities continue to operate as though universal anchors remain intact, they may underestimate the time and coordination required to achieve stabilization. Delays that would once have been tolerable can become destabilizing. Measures that would once have been decisive may now produce muted or uneven effects. The negotiation of influence becomes central in this environment. Rather than relying on structural dominance, the United States and other systemically important actors must engage more actively with partners to align responses. This requires diplomatic capital, institutional trust, and a willingness to accommodate diversity within a coherent framework. Influence exercised through consultation may be slower, but it is more sustainable in a fragmented system. The alternative is unilateral action that risks bypass or dilution through alternative channels. Systemic complexity also alters market psychology. Investors and institutions adjust behavior based on their perception of collective capacity to manage shocks. When coordination appears uncertain, risk aversion increases. This can become self-reinforcing. Higher volatility justifies further fragmentation as actors seek insulation, which in turn increases complexity. Breaking this cycle requires credible demonstrations of cooperative capacity, not just liquidity injections. The test confronting the global financial system is therefore not one of collapse, but of adaptation. The shift in monetary alignments is already embedded in infrastructure and practice. Reversing it is neither feasible nor desirable. The challenge is to develop governance mechanisms that can operate effectively within a less centralized architecture. This includes improving transparency across systems, harmonizing critical standards where possible, and strengthening channels for rapid consultation and joint action. For the United States, adaptation involves recognizing that leadership in this environment is exercised through reliability and restraint. Markets respond not only to the scale of intervention, but to its coherence with long-term policy trajectories. Fiscal sustainability, regulatory predictability, and institutional continuity become strategic assets. When these elements are credible, they anchor confidence even in a fragmented system. When they are questioned, fragmentation magnifies the consequences. The rising complexity of monetary alignments is not a transient phase. It reflects structural changes in trade patterns, technology, and geopolitics. Managing this complexity requires a shift in mindset from command to coordination. Influence must be earned repeatedly through effective stewardship of shared systems. The stakes are high because the margin for error is narrowing. High leverage, geopolitical tension, and institutional fragmentation interact in ways that leave little room for miscalculation. In this context, the future of global financial stability depends less on restoring a single dominant anchor and more on strengthening the connective tissue between diverse components. Trust, interoperability, and clear communication become the primary stabilizers. The system can function under these conditions, but it demands a higher level of discipline and cooperation. The question is not whether U.S. power disappears, but whether it evolves to meet the demands of a system where influence is contingent, coordination is complex, and stability must be actively maintained rather than assumed.